Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. My name is Marco Iachini, and I'm a cross-asset strategist from our Chief Investment Office team. On this episode of the podcast, we'll discuss the latest U.S. inflation data and what the implications are for the Federal Reserve Bank. We will look at why U.S. Treasury yields declined after the data came out, and then we finish off with some color on equities. Joining me today for this conversation, I'm glad to welcome Audrey Go, our Senior Cross-Asset Strategist. Let's start with question one. The May U.S. Consumer Price Index came in at 5% versus last year in May. This was a widely anticipated data point as market participants try to guesstimate how it will change the Fed's reaction function. Now, what's your thinking, Audrey, about this latest inflation data and how will it affect the Federal Reserve?
Thanks, Marco. So if you look at the latest US CPI print, it basically rose by more than consensus expectation and hitting 5%, which is a 13-year high. And against this, we have seen US equities hit a record high while 10-year Treasury bond yields actually slipped lower, which in my mind may suggest that the market basically agrees with the fact that the current bout of inflation is likely to be transitory. Now, the big question or the elephant in the room is when will the US Central Bank take away the punch bowl? And in our opinion, next week's FOMC meeting is probably too soon for the Fed to signal any change, although there is a rising chance that it may announce a tapering of its bond purchases over the next 6 to 12 months. This, in our mind, is unlikely to surprise the market because the investors are already anticipating a Fed rate hike by the first half of 2023, which implies that tapering is likely to start earlier, likely in 2022 or late 2021. We believe the Fed will be guided by two main key factors in any decisions to taper. The first is on US jobs market, and the second is on US inflation. We have seen a string of weaker than expected jobs creation number in April and May, and this in our mind will likely push back any Fed tapering talk, and also partly explains the pullback that we have seen in US Treasury yields in the recent week. Although the US jobless rate has fallen from post-pandemic high of 14.8% to 5.8% in May, there are still ample of labor market slack. So if you look at the US, for example, they will need to recover at least 8 million more jobs in order to reach Fed's maximum unemployment goal. And on inflation, we believe this week's inflation print, which saw core inflation surging to 3.8% year on year, marking a 29-year high, will probably imply a peak of this cycle. The surge that we've seen is in fact due to base effect because of the slump in prices that we have seen in crude oil and other prices during the trough of the pandemic back in Q2 2020. We do expect some of these pricing pressure to decelerate as supply chain bottleneck eases, as company add capacity, as we continue to progress towards 2022. That said, the Federal Reserve may start talking about tapering earlier, perhaps as soon as the Jackson Hole conference in August this year, if labor markets inflation were to evolve as they expect. However, we believe that markets are much better prepared this time for Fed tapering compared to back in 2013. And at the same time, we are having more frequent Fed communication, which should also reduce the scope for policy surprises. Given this backdrop, we continue to maintain our pro-risk stance, advocating investors to consider averaging into dips on any equity pullback based on our outlook of strong economic growth as well as on earnings expectations.
Thanks, Audrey. I wanted to touch on one more thing related to, obviously, the inflation data print, and that's the reaction of U.S. Treasury yields. At first, immediately after the release of the data point, they jumped, but then we saw that gradually throughout the U.S. trading session, they marched lower. Are we at a risk of breaking further on the downside here, or what's the team's view on this?
Well, the U.S. 10-year Treasury bond yield, in fact, broke below the key psychological 1.5% level overnight, and it's now testing its May's low of around 1.4, 1.45, 1.44 levels. Should yields break through this level, then the next key area of support will lie closer to 1.3%. Fundamentally, we do believe that some of the recent decline in yields may be overdone, which in our opinion should lead to an increased likelihood for a modest rise in yield over the coming months. One such catalyst for this would be a renewed focus on Fed's tapering, which will be a driver for yields to move potentially higher. And that would certainly imply a steeper yield curve as well, given the rising or expanding difference between the short and long-term yield increases. In terms of the next resistance level, we will watch out for around 1.7 to 1.71%. This level is key and will need to be broken if we want to see some of the current downward pressure on US Treasury bond yields to fade.
Understand. Thank you, Audrey. Those levels are always useful. If we can switch gears for a moment and move on to equities, we saw that with the latest G7 meeting, there was some agreement about the minimum corporate rate tax globally of 15%. What's the team's take on this, and will it impact equities in a negative way?
I think from a sentiment perspective, that will probably be a dampener to investor sentiment. But that said, if we were to look at the actual impact from a minimum corporate tax rate of around 15%, this in itself would represent an estimated headwind of less than, say, 1% to S&P 500 earnings. And in terms of the sectors most likely to be impacted, we would include the likes of technology as well as healthcare sectors, given their low effective tax rate as well as high proportion of foreign income coming from foreign sources. At the moment, there are still uncertainty about the likely impact of these new tax proposals, as it will also depend on how governments implement these policies and when it will be implemented. So in the meantime, we do believe that investors should watch for some other factors such as global stimulus, inflation, and earnings growth, which remains much more important driver of equity markets over the coming months, in our view.
Got it. So to summarize, the recent drivers of overall equities outperformance so far year to date are what's more important for now, even though the worries about the tax could be in investors' minds later down the road. Now, if I can, one last question on equities, just to remain on this topic. We saw Chinese equities being an underperformer year to date, but in recent weeks, they started to gain some traction and cut some of the slack versus other equity markets. What is your view on Chinese equities, and is there further momentum down the line?
Well, Chinese equities have corrected significantly since the beginning of this year on concerns over policy tightening. And after some weeks of consolidation, we've basically seen Chinese equity prices regaining some grounds. We continue to believe that Chinese equities is a core holding within Asia ex-Japan equities. And within that, we do have a preference for onshore over offshore equities. If you look at flows into onshore equities, foreign investors have remained rather undeterred, even given this concern about policy tightening. In fact, northbound flows into Chinese assets continue to stay quite resilient. And at the same time, we also believe that any further gains on CNY, for example, will also help to offset, to some degree, investors' concern about inflation impact from rising commodity prices in China. Now, while Chinese equities have historically struggled to do well during periods of high PPI inflation, we do not believe that we would see outright policy tightening, given that such policies are normally not used, given how blunt they are, to tackle supply-side constraints. And at the same time, there have also been weak correlation between PPI, which is the Producer Price Index, and CPI, Consumer Price Index, in recent years. Certainly, the key risk to our more sanguine views on Chinese onshore equities are if there were to be any flare-up in US-China trade tension, as well as any significant decline or depreciation in renminbi, which may then trigger concerns about capital outflows from the Chinese onshore markets.
Fantastic. Thank you very much, Audrey. And thank you for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thanks for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.